started. As you can probably tell from the title, we at Saxo right now thinks we are in one of the single biggest paradigm shifts that we've had in the marketplace in basically since the 1970s. To put that into perspective, what we need to address, of course, is that over the last 24 months, we've had three major events, three small paradigm shifts that added up together means that we are in a total different environment and market conditions that we had before. The events, of course, will, to a large extent, is covered in 2020 and 21. It is now the Ukraine war as the tail end of the events. But in between those two, sandwiched in, is the fact that in November 2021, the Federal Reserve became a inflation hawk. The actual event that drove this was basically the White House who called in Chair Powell, who at the time was seeking a renomination. And the White House told him and read him the riot act saying basically that, listen, you are trying to get 5 million people in the US to go back to work. Why don't you focus, as you are mandated to do, to keep the paycheck for the 200 million Americans at work, whom you, by your conduct of monetary policy, is now deflating and hollowing out their earnings income. On the same day, on the press conference where Powell was renominated by the White House, he changed the tune that he had as a narrative for Federal Reserve. Until then, as you all know, it was about being inflation being temporary and very much still cyclical. That pivot point is also, to a large extent, the high that we've seen in the valuation of the market. The reason this and these three went together is important is that it, number one, it underlines the score and the macro theme that we've had for many years, which is that the physical world is too small for the combination of fiscal policy, monetary policy, and of course, ultimately also the constraints that sits within the political system. So we've had a breakdown in what operates. And the first conclusion you want to take away from this report today is that for the first time since the 1980s and the 1990s, there is now a direct consequence of not fighting inflation. Or in other words, since 98, in particular, the LTCM bailout, the market has been operating on a model where they've said, listen, we can induce liquidity into the system, and at the same time, we can lower the governing interest rates without having an impact on inflation. That disappeared in November, rhetorically. But of course, already in November, we were already trading at a CPI of more than 5%. So it's been embedded into the economy. This is important for you as an investor, as Peter will talk about, because what it does is that exposes the convexity, the non-earning companies, the long duration equity stocks, which is primarily in earnings growth. They are being exposed to this phenomena because essentially what happens here is that a small change in interest rates have a material impact on the valuation on the spreadsheet, of course, through the discounting of cash flows. And when you trade very close to zero, of course, minute changes in interest rate, both up and down, will have a relatively large exposure change. On top of that, of course, the Ukraine war created for us militarily the single biggest turnaround that we've seen since the Second World War. A number of countries, including the Nordics, have pursuing a policy since 1989, when the Berlin Wall came, that we were living in a naive concept of peace in our times. Now that is being put to show, or is it being shown to be not only naive, but an extremely dangerous way to conduct your military policy, and besides that the overall security policy. Combine that with the lack of resources that we have in the economy overall, and the energy crisis that prevailed during the long nights of the winters this winter, but also now we see the same results coming into the food prices overall. As we talk today, there's already food rise and inflation demonstrations in Peru, in Sri Lanka, and in Pakistan. And we fully expect that this impact will be growing in terms of geographic reach, but also even into the Western economies like the US, UK, and potentially even the Nordic countries. There is also on the security policy a massive change in Germany in particular. Germany decided to go away from the policy of not having foreign soldiers on foreign, having their own soldiers on foreign soil. And I've just been to Helsinki, and in Helsinki, we are also having a Finnish government who, backed by a massive poll support, is probably going to apply for a membership of NATO. In other words, in the space of the last 2 years, we have changed from a world of globalization to a world of deglobalization. We have changed from a world of having no inflationary output from all of the fiscal and monetary stimulus that's been done. And we've had a green transformation, which in its cost structure remains extremely expensive. And the reason we know that, of course, is that we operate in a world of negative real interest rates. In other words, the compensation we get in yield is smaller than the actual inflation. That hides the fact, or that is the consequence of a policy and a setup of a system which tells you that we live in non-productive times. The only way we can sustain part of this green transformation is to maintain an ever lower negative real interest rates, meaning that the productivity in society is not rising. And here we also think there's a material change in the outlook. I personally operate on a premise that the increase in military spending, the increase in infrastructure spending that we will see in countries like Germany, who for the record during the COVID-19 lockdown could not homeschool because the German internet didn't have enough bandwidth. This is a country that needs to be digitalized. It's a country that needs to have better communication lines. It is a country who needs to revisit their strategic military strategy. It is a country that need to be able to be a deterrent, who need to be militarily strong enough to fight off an enemy. This is not only big spend in terms of money, in this case, euros and cents, but it's also a country that will, over the next 2 to 5 to 10 years, will move from at the back of the classroom to the front, simply because in order to be deterrent, in order to be prepared and ready, you need to change the underlying structure of that economy. That's one of the reasons that Peter and the equity team has been very positive on defense for a number of years. So in closing, I will say that what we're trying to do with this outlook today, and my great colleague will exemplify this through what they talk about, is to say that things have changed. This is for the first time a story where even if the consensus is right, and the Federal Reserve can only go ahead and do 2 or 3 or 4 interest rate hikes before they move back to the old agenda of every time the stock market is down to provide liquidity or alternatively lower interest rates. But if they do that right now, with the inflation genie out of the bottle, they will only have one result from that. That is like, it will be certainly that we will see even higher terminal interest rate and higher terminal inflation rates. That could be the 1970s over again. And I think there is, and I agree with the consensus, this is a big risk. But I'll have to say at the same time that we are relatively constructive as long as you, as an investor, stay with the tangible assets, when you stay in the real world and you realize that going forward, there will be less recycling of capital globally as we move from globalization to deglobalization, and also because the strategic resourcing and the way that governments and companies will position themselves will not be in a process of just in time, but in a process of being able to deliver, including having more storage of goods. We actually think a lot of governments will change some of their reserves into actual fiscal underlying commodity reserve instead of having them in dollars and cents. So in other words, ladies and gentlemen, we have a paradigm shift, and I hope you will enjoy what is coming up now with our great Saxo strategy team, which will start off with Peter Garnery. Thank you very much.
Thank you. Thank you, Steen. Let me see. Well, I hope this is the right one I'm sharing. I'm getting a thumbs up, so that's good. Okay, so let's start with the helicopter view on equities. This is the MSCI World. It's the benchmark index for global equities, and some of you, the ones that have been reading our research for years, will know this chart. It's the one we use to show where we are in terms of valuations, and as you can see, we are still using a range of different valuation metrics. We are still one standard deviation expensive relative to the history since 1995 at least, and I think in many ways that's remarkable given the input cost pressures that are on companies, the operating volatility. We have a large-scale war in Ukraine. We have interest rates on the rise, which increases the discount rate. There are history rhymes. It's never a copy. I don't think the next 8 years will be a copy of the 1970s, but there will definitely be a lot of similarities. And one of the things we have to think about as an investor is that the 70s and structurally higher inflation um, causes valuations basically to come down. That is what we have seen. That's not to say that companies can't grow earnings, they will, but in aggregate terms, if you have investors being willing to pay a lower valuation multiple because the alternative interest rates because of inflation goes up, then even though you have growing revenue and earnings, it's quite a headwind. So we definitely see equity valuations being under attack. In our quarterly outlook, we zoom in on productivity and innovation and the military for all the reasons that Steen mentioned. And there are many different ways of highlighting innovation and productivity. I think this chart is quite interesting. So on the x-axis, you have the number of employees in companies. I think we have almost, I think, 2,500 companies in this blob of dots here in the world. And then on the y-axis, you have adjusted net income over a 3-year period to the number of employees you have. So basically, as the company goes up in size, you have a negative relationship. So your profitability, your productivity, the profit you can make from each employee goes down. That's because increased complexity, increased bureaucracy, etc., etc. Everyone that has worked in a big company know what I'm talking about here. And the further away to the upside you are from this regression line, the more profit you're cranking out per employee relative to your size. So that's in essence a productivity measure by itself. And actually, the company with the highest spread to this regression line is Apple. Not a big coincidence that this company has become the world's most valuable company. Actually, a lot of the technology companies, the big ones that are today one of the largest companies in the world, are actually the blobs just below Apple. So again, very productive. But if you take the two companies within each industry group that has the largest distance to this regression line, then you get a list of what we call the most productive companies within each industry group. And I've put it in the list here to the left. The table is a little bit small, so I hope you can still read it. Otherwise, you will have the PDF, so you can zoom in. But basically, here you have all the companies that are doing the best on generating profits relative to the size of the company in terms of employees. Innovation is a different thing. You can measure innovation in many different ways. The number of patents. You have something called R&D intensity, and that can be measured in many ways. We have chosen the one way, which is the R&D expenses the company applies relative to its revenue. And again, we have taken the two companies in each industry group, and here we have taken the industry groups where you have R&D. So banks, insurance companies, and a few others industries, they don't have R&D on as part of their fundamentals. So that's why this list is shorter than the list on the productivity. And I've listed the companies here that have a lot of R&D relative to their revenue, and a lot of the names I presume you can recognize here. And there are some pretty good academic research that have been done on this, that companies that generally have a high R&D to revenue is doing quite well in the long run. And then actually we have got a new ETF. Unfortunately, this is only for professional investors for the time being because it's a US ETF. But hopefully we'll get an ETF in Europe that is UCITS compliant, so we can so it's available to the masses, at least here in Europe. But this ETF here, IQ Global Equity R&D Leaders, is an interesting one to watch if you want to have a broad-based exposure to these type of companies. And then, as Steen mentioned, my last slide is on the defense industry. So we are living, or we are going through a paradigm shift. It's it's very obvious and it's quite clear that the EU, that Europe has changed on the 24th of February 2022 when Russia invaded Ukraine, and Europe is now on a blistering pace to take their military spending to 2% and even beyond, as in Germany's case and in some other countries' cases. And if you take the current military spending and you factor in a growing European economy over the next couple of years, and then you multiply by this expansion to the 2% or above, it actually at double-digit growth rate we're going to see in military spending. It could be as somewhere between 10 and 20%, give or take. And this list here you can see on this slide are the ones we have in our defense baskets. And we're also working actually on making this defense basket available in our Saxo Select universe, so clients can get access to it. It's a difficult theme because there is no widespread ETFs because of the ESG environment we're living in. It's not really the theme that was on the radar, but this is going to be a multi-year growth industry, and we also talk about in the outlook and link to it that have been some research done in the OECD countries linking rapidly increases in military spending and the R&D in the government sector. It filters through to the private sector, so there are actually a lot of benefits from innovation in this sector. So this is could be quite crucial for Europe going forward. So that was a little bit of inspiration on equities. It was a short rundown, but I'll now give the word to John Hardy to Ole. I've been told Ole on Commodities. Thank you.
Thank you very much, Peter, and hello, good afternoon, everyone. Commodity space has been obviously on fire during the past few months here, but it was already on the move before the war in Ukraine turbocharged several of these key commodities, and it's just basically strengthening the idea that we are in a multi-year commodity rally. The coming quarter, as you can see on the return to the slide deck, is probably going to be one of consolidation. We just come out of probably the strongest quarter ever for the commodity sector. I hope you can see my slides, John. Yes, there it is. So more than almost around 24% gain during the first quarter, led by the energy sector. And following such a phenomenal run, it's quite natural that we will have some kind of consolidation. And also the market, probably in the short term, just worrying a little bit that some of these very high prices is going to have an negative impact on demand, thereby trying to potentially helping to balance some of the markets. But overall, the commodity super cycle, I've just highlighted some of the reasons or some of the drivers for a super cycle. We haven't had many. The last major one was from the early parts of this millennium when we really had the run up in prices. Let me just see if I can share my screen, because then we can make sure we're looking at the same thing. And many of these will continue to be the main drivers going forward as well. So as we got the handout, so you can take a closer look in some of these drivers. Take a look at crude oil. First of all, the energy sector crude oil together with gas has been some of the major performances during the past few months here. The spike in crude oil was quite phenomenal back when we had peak panning in early March. Since then, the market has stabilized. We are coming down at this point where we have broken the uptrend yesterday from the December low. We're below the 50-day moving average. Could indicate that we are entering a period of consolidation. But while we in the past have been looking at a few 100,000 barrels mismatch between supply and demand, basically driving the prices, we are now looking at millions of barrels daily in mismatch, which is just creating a very, very volatile environment. Just look at the Russians' ability to sell crude oil right now. They are selling the Urals quality at a discount to Brent of more than $30. Basically highlighting not the lack of interest in the global market, but lack of buyers due to sanction and self-sanctioning. On the other hand, we have the COVID outbreak in China, which is continuing to spread. Potentially 200 million people are now indirectly impacted. That is slowing down the consumption of fuel, and that's basically offsetting some some of the losses we are seeing from Russian barrels not reaching the market right now. At the same time, both the IEA and OPEC EIA in the US will release barrels from strategic reserves over the coming weeks and months, and that should also go some way to alleviate some of the worries in the system. But the structural problem remains the same. We have to remember that in order to maintain production at current levels, we need to find between 5 and 8 million barrels, new barrels every year, just to keep production stable, and that is really the challenge in the years to come. That the structural change and an oil company basically looking at not really knowing what the oil demand will be in 5-10 years time. They will be struggling entering into these very long-term projects, which will ensure the adequate supply. So that is our main reason for seeing the market maintaining a bit once we get on the other side of the dislocations we have right now. And with that in mind, for the quarter, basically, as we put in the outlook, quite a phenomenal wide range, but obviously $30 range was what we almost saw in just one day alone back in early March. So looking for a range this quarter is somewhere in the region of $90 to $100, but some consolidation here first up. Moving to gold. Probably generally when people look at gold, they talk about their disappointment that it hasn't done better than it has done, especially considering that the inflation is where it is. But I think gold is doing actually phenomenally well, because you have to remember gold. You should treat gold as part of a general portfolio. If you are just purely focusing on gold, yes, you will be disappointed, because the return has not been great the last year and a half. But if you keep gold as a rainy day insurance against worries elsewhere, then it's done really well. In euro terms, you made 3.5% last year. That was in a year where the stock market rose by more than 25%. So far this year, you're up 10% in gold in euro terms. At the same time, the S&P is down, and global stocks in general are struggling. And this is really a phenomenal performance so far, because real yields, which we can see, I believe, on this slide on the right-hand side here, the correlation between real yields and gold has broken down at this point, and that's what has been the head scratcher for those who are holding a bearish view on gold. That it hasn't really, that the real yields has risen as expected, but gold has not fallen as some would have expected. And it's basically because we are seeing a change in the investor focus. We are seeing renewed demand from long-term investors. You can see that here on the left-hand side. In ETF holdings, they've been going up and up for the past few months. Even during the $175 correction we had after the failed break recently, the buying was continued as gold corrected lower. At the same time, more short-term technical driven, sometimes also algo driven leverage funds, they have been selling out of their net longs in recent weeks. But the underlying bid from asset managers remains pretty firm right now. They're looking at inflation. They're looking at growth worries. They're looking at the central bank, but the FOMC potentially, or the Fed potentially doing a policy mistake, basically killing growth to the extent that they have to take the foot off the rate hike pedal, and also just this very elevated volatility we have, especially in the bond market, and to a certain extent also in the stock market. This is the main catalyst for drivers for investments into gold. And I think at this point in time, we're trading at 1928 today. We are well above support. We have had a very, very hawkish FOMC minutes. We've had a stronger dollar. We've had the collapse or the rally in real yields. We had the expectation for close to 25 basis point rate hikes over the next 10 months. These are all in the prices. So you really need to come up with more than that in order to look for reasons that potentially that could send gold lower. So we maintain a bullish outlook for gold on that basis. And with that in mind, something like silver and platinum should be doing well as well. Platinum, it looks very cheap right now. It's nearly $1,000 below gold, and silver has also been struggling recently. But that is more tied in with the copper story. And copper is also one where we are looking for some upsides. Just as a quick overview of some of the green transition metals, and which will become an increased focus over the coming. Well, it is already, but that will probably intensify given the willingness to look for alternative source of energy than Russian gas and oil, and we have to remember that commodities price of commodities can go up even if we have an economic slowdown, because the focus right now will be on supply, which is very tight, and it also will be on these demand for renewables. It will be focused on Russia. Even if the war stopped tomorrow and sanctions to a certain extent were lifted, it will still take a long time for production and normality to return with regards to Russia and how they're treated. So just keep that in mind, that there's a lot of metals going into this green transformation. A lot of focus recently on the battery part of that. There's lithium, cobalt, zinc, and nickel. They've all been rallying very strongly. We're bullish copper. It's actually one of the metals that's done the least over the past year or so, while some of the others have rallied strongly. It hasn't done much because copper is the metal that's primarily used also from a macroeconomic perspective. And there are some macro concerns right now with China, the property crisis last year, the COVID lockdowns right now, the FOMC hiking rates. What does that do to growth? That macro uncertainty is priced into the copper is used as a gauge for that. So that's on the macro level. But then if you look on the micro level, you have inventories, stock levels continuing to fall. Goldman Sachs, in the latest report, actually highlight the risk of a stock depletion. And it is interesting to note that March normally is a month where copper stocks globally tends to rise because it's a low demand period. This year it's actually been falling. And this is actually at a time where the market has been relatively lukewarm on the metal. Stocks are still falling. So imagine what happens if suddenly we have a turnaround on that front. So we think supply will be tight, led by lack of supply or lower supply from Chile for various reasons, and also what I mentioned with regards to Russia. So the upside for copper is one that it continues to increase in our mind, and you have to remember as well, the speculative interest has been much reduced in recent months because it hasn't really been doing much. So there's plenty of room for fresh buying to come into the market. I'm running a little bit out of time, so I'll just quickly take you through a quick look on the agricultural space, because again, also a market that's been uprooted by what's been happening in Ukraine and Russia. Again, have to remember that Russia is the second largest exporter of anything from metals, energy to agricultural products on a global scale, and that's why it has had such a profound impact as well on the agricultural space. Focus over the coming weeks and months will be the Black Sea region. Can Ukraine get back to the ports? Can they start to export again? The weather, which is already now playing havoc in the US. We got the worst crop conditions for winter wheat in at least a decade. Acreage allocations will be key. Into this, the market will be or has been focusing on the cost of fuel and the cost of fertilizers. Fertilizer has been rallying like crazy because it's produced by natural gas, and that has led to a change in acreage in the US away from corn and wheat towards soybeans, and that's actually not what the market needs over the coming months. So that will also continue to keep these market tight. So the agricultural space, unfortunately, is one where we still see underlying bid in the market, just simply due to lack of or worries that there will be tight supplies as we head into the autumn following the coming harvest season. And just finally, just a few ideas about ETFs that can be accessed and can be traded that covers these indices. Primarily the Bloomberg Commodity Index that we focus on. I like it because it's a third in energy, then metals and agriculture. So it's a wide spread index, and on this one, it gives you an idea about some of the broad indices and also some of the more specific sector ETFs that you can look at. Okay, that's it for me. I'll pass you on to John. Thank you very much.
Thanks, Ola. Hopefully you can all hear me and see my slide deck. All right, let's talk about FX. And so, of course, what we have with this environment, the inflationary backdrop that Stein alluded to, and that it's driven by the supply chain disruptions, the combination of the supply chain disruptions from these twin pandemics, with the demand stimulating response. We have a very unusual economy here in that we didn't really see in this very, very sharp downturn very significant impact on especially private balance sheets, particularly in the US. So a lot of people in the US lost their jobs, but were compensated and saw their incomes ironically going higher and growing more than they've ever seen in their lifetimes. In Europe, there was less stimulus, but there was also less job loss because of social security mechanisms kicking in. Not social security, but sort of job security mechanisms kicking in to keep people from getting fired in the first place. So now we're all rushing to normalize policy. And this chart here shows the different currencies, the 2-year rates for these different currencies. And you can generally see all these little fishes are swimming in the same direction, led by, at least in absolute yield terms, you have New Zealand at the top there, 2-year rate at, these are swap rates, so it's not the policy rate necessarily, the government sovereign yield rate, but it's close to that. At 3.5%, a bit lower, we have the likes of Canada, Australia, and even the US dollar played a lot of catch up, getting close to 3%. And even look at the very bottom there, the Swiss franc getting up towards above 0. But look at of course, the one that's not moving at all. What's that? It's the Japanese 2-year rate. We have the Bank of Japan, uniquely among banks, that is doubling down on its commitment to its existing negative 10 basis point rate policy and its yield curve control policy, under which it caps the 10-year yield at plus 25 basis points, meaning that as yields rise elsewhere, if all other things being equal, Japanese yields can't sort of rise together with the rest of the world, then the transmission effect and the weakening effect has to be transmission into the currency. So that's one of the very unique things. And of course, these yields have been playing various degrees of catch up and lagging with one another. We still have the ECB in relative terms dragging its feet. There was a eureka moment where they started to normalize directionally, but you see that strong blue line there dipping quite strongly into February into early March, because Europe is uniquely negatively impacted from the energy angle and energy price angle, and therefore from the real growth angle from the limitations and high prices on natural gas supplies. However, one of the things I emphasize in the Q2 outlook is a constructive outlook for Europe, provided we can get to the other side of these divergently and disproportionate impacts into the Eurozone from the cessation of and limitations on supplies and the very high prices of those energy supplies from Russian natural gas. And you can see the scale that this has affected a fundamental like the EU trade balance, which was running absolutely enormous surpluses in the post EU sovereign debt crisis era. That sovereign debt crisis basically put peripheral Europe into a deflationary depression. So consumption was crushed in the likes of Italy, Spain, and elsewhere at the periphery, and those countries were forced to start running nominal current account surpluses. And Germany was always running its giant surplus engine. So the EU bloc was always a massive surplus bloc, and yet the Draghi ECB took those yields, kept them negative to prevent any euro strengthening. But now we have, as Stein mentioned, a massive fiscal adjustment in Europe with new defense priorities, massive defense priorities on the order of 100 billion euro defense spend this year alone from Germany. There's also an EU defense spend, and a classic currency positive is loose fiscal combined with tightening monetary, and that is what we're getting. So we are constructive long term, but with this overhanging uncertainty around, of course, the impacts from that are falling especially hard in Europe from the cutoff of supplies to some degree, and the very high prices for those supplies, particularly of natural gas. Yeah, so that's Europe, and then we can look at another place where we're seeing the opposite effect. So we have Australia, which suddenly is just, it's always been somewhat of a commodity superstar, because especially the focus being, in the last 20 years on its very strong exports into China, iron ore and coking coal especially. As if that weren't enough, and these were quite massive, it still wasn't massive enough for Australia to run a nominal current account surplus or trade surplus. But now, over the last 10 years, they've developed a huge natural gas productive facilities and production. They don't need but a tiny fraction of this for their own domestic use, and they have become the world's largest LNG, so liquefied natural gas exporter. So they added that to the portfolio. They've always been strong on food, especially wheat. That's been impacted by the war. And as if that's not enough, as we transition into alternative energy, and especially electrification and EVs in particular, it is the world's largest producer, bordering on 50% of the entire global production at the current moment of lithium. So there's basically nothing that Australia doesn't have. So as long as commodities are in a cyclical upswing, Australia stands to do well from that angle. As Ola said, maybe we've gotten into we might risk a bit of consolidation near term. We did see Australian dollar tumbling a little bit this week. It's still very risk sentiment prone, but a very strong long-term fundamentals there. And on the right, I'm showing you the Aussie versus the yen. So we have that unique Japanese central bank policy story versus this incredible commodities focus on Australia, and what a boon it has proven to the Aussie versus yen equation. And on the left, you're just showing the LNG price. So the largest exporter, and prices have gone wild, especially because seaborne LNG is being bid up across the world, because Europe has, besides its defense priorities, energy diversification priorities. That means it is looking to diversify away from Russia to whatever degree possible. So as we go into this quarter, we're looking at something that's very interesting and is going to have implications, and it had huge implications the last time this happened back in 2015. And that is what I'm showing here, which is the yen is extremely cheap. Japan has a high value add, high technological profile export mix, and China is trying to move in that direction as well, away from the lower end stuff towards the higher end, more sophisticated export product assortments. And then you see that the exchange rates of these two currencies could not be more divergent. Back in 2015, similar setup. The Chinese currency, the Chinese renminbi, was tracking the dollar stronger. It was becoming too painfully strong to continue doing that, and China devalued effectively with a new exchange rate regime. Now, at that time, it had the luxury of doing so because that strong dollar was taking commodity prices very steeply south, particularly energy prices. That is not the case right now. So I think China is going to hold on to this policy for some time, as long as these commodity prices are extremely high. And but at some point, I suspect there's the risk that either that the gap has to close one way or another, that Japan will find that the cost of living increases on the commodity side are becoming too painful, they'll have to abandon their policy, and or that China begins to normalize a bit relative to with its exchange rate relative to the rest of the world if commodity prices take a breather. So watching out for that. It's a key year for China politically and otherwise. Look at the dollar as well, towards multi-year highs. In fact, towards highs all the way back to prior to the financial crisis. I think we're pricing in about as much from the Fed as we're going to get pretty soon here. I think it's getting into the upper echelons of what's possible, and that was underlined this week with some further indications of very strong quantitative tightening. The Fed is now priced to and expected to do QT, so quantitative tightening, on the order of $2 to $2.5 trillion a year, a run rate that I think is eventually going to get the market in trouble. And I think globally, we're going to see, especially China, wanting to diversify away from holding dollar reserves. It is the world's largest holder, far and away. And I think, as Stan indicated, there will be an interest in having a diverse holding of non-FX types of reserves, commodities and otherwise. So I think the dollar, though it is strong now, could get a little bit stronger as we deal with the extreme tightening that's getting priced in, is set for a significant and secular decline in the years ahead. Global financial conditions, the Fed has gotten behind the curve. It looks like it's trying to catch up now. Interesting to see if it does so. This is key for, in the near term, for emerging markets. Risk indicators, and we've seen emerging markets doing very well because they've bought credibility with significant tightening of policy rates, while the large central banks have been very slow to move towards tightening. And this is just just to show a sort of based a scenario or a specific case, an example of what's going on with the overstoking of asset markets once again in the pandemic response. This kind of response, by the way, policy response, is just not doable again in the future, given the underlying inflation. And that is, as central banks cut rates again once again to zero, flooded the economy with liquidity to ensure that incomes did not fall. We saw the usual suspect, housing flying higher. So here you have the Canadian housing, and this could just as well be U.S. housing, flying higher to the tune of almost 20% per year. It did reach close to 20% per year recently in the U.S. But look at the mortgage rates. That's the black line, tightening rapidly. And I put the 5-year Canadian here because Canadian mortgages are based off the 5-year. We are at the highest levels in over a decade, and this will lead to a huge reversal in the outlook for private balance sheets. And this tightening will lead to something eventually breaking. So the Fed has been forced into the policy of tightening until something breaks. Financial markets will probably break a little bit earlier than the actual economy, but that's what we're heading towards, and that's what the negative or yield curve going into negative territory is indicating to us. I'm jabbering on a bit too long here, so I will cut it off there, and I'll send you over to Anders for a few thoughts on cybersecurity. It's an very interesting area.
Thank you, John. So in this quality outlook, we actually have a special edition on cybersecurity. And the reason is that immediately after the invasion of Ukraine, saw a large boost in the number of cyber attacks. And it was especially focused on Russia and Ukraine. Over just 2 days, the number of attacks increased by more than 800%. So looking at a map here on the chart from Kaspersky, so an antivirus service provider, we can see that the largest, most attacked cyber attack country last week was Russia, with Ukraine being the second largest, and the attacks origins from United States and Russia. Why is the rest of the world so concerned about all of these cyber attack increases when they're just mainly focused in Ukraine and Russia? And it's of course, if we remember back to 2017, the NotPetya virus, which was initially targeting Ukraine and also hit more than 80% of its targets were in Ukraine. But just within a couple of hours, it actually spread out to the whole world, hitting the shipping company Maersk, hitting FedEx subsidiary in Europe, a hospital in Pennsylvania, even the radiation monitoring systems at the Chernobyl power plant. And the estimates were that these attacks resulted in damages for more than $10 billion. And also you can say, in general, the number of ransomware attacks has increased by more than 100% just from 2020 to 2021. And one very good example is the one here shown to the right, the cyber attack on the Colonial Pipeline, which took down, which led to shortages across the East Coast in US. And this increased number of cyber attacks, of course, makes governments and big companies nervous about their critical infrastructure and their supply lines. So what we're actually seeing right now is that we see governments are realizing they're way behind when it comes to cyber defense. US President Biden has signed a law stating that big companies, they have to report at least within 72 hours if they are experiencing any big cyber attacks. And also here, as shown in the slide, UK, Australia, and Denmark, they are calling for actions to both boost the government's cyber defense, but also especially the cyber defense of small and medium companies, as they really see that they are quite vulnerable to cyber attacks. So this is definitely something which is trending right now, the cybersecurity theme. And the way that we track it here in Saxo is that we have a cybersecurity basket of 20 stocks, and you can see those in the quarterly outlook PDF. And if you look at the companies, they have generally had quite large revenue increases over the last years, as shown in the chart to the left. But more than half of the companies had negative profits over the last year. So it's definitely an industry where growth has been prioritized over profitability. And what we're also seeing is that there's a rapid consolidation going on right now in the industry, where a lot of the bigger players are buying the smaller players, which over time should increase profitability. Also, if you look at the performance of cybersecurity basket compared to a lot of the other theme baskets we track here in Saxo, as shown to the right, it has actually been performing quite well year to date. Of course, these past returns is not any indicator of the future returns, but we do see this increased globalization, increased digital world on a global basis. We see this as a major trend, and of course also we see increased cybersecurity risks with this digitalization. And the invasion of Ukraine has definitely been a wake-up call for governments and big companies to bolster their cyber defenses. So we follow this theme quite closely, and you can read much more in our quarterly outlook. And now we'll open up for the question session. Thank you.
Yeah, for those that may not have noticed, several of you have, of course, there's a questions module on the right side. I'm not sure exactly how your view looks compared to mine, but a number of questions have popped in there, so feel free to add to those. And if you have any questions, I'll take a couple of these. So one was, when will be a good time to buy euros, and when do you expect the dollar to decline? So I think with the model being that the Fed is going to hike until something breaks, it may take a little time for something to break, but I think this rate that's being priced in of a 2, or let's call it 2 to 2.5 trillion per annum tightening will quickly be too much for the market. So the economy may take a little bit further time to roll over, but markets are going to be in rebellion, I think, before too long over this pace, once the Fed is getting the respect that this policy trajectory deserves. So inexact, but I would guess as we get into certainly into Q3. As far as the euro, I think it's very much dependent on the situation. Again, the divergently disproportionate burden that the Eurozone is suffering under this Ukraine war in terms of energy prices. And we actually have this, this was not something I anticipated at the time I was writing the outlook, but the French presidential election, we have to track this. I'm assuming that the still very strong odds that Macron emerges victorious remain the case, but if there is a shock in the polls, anything akin to what we saw in Hungary, for example, and we see the risk that Le Pen becomes the president of France, it's a complete and utter game changer. We just have to make sure that doesn't happen before we start anticipating a euro rise. But certainly, I would hope that the euro starts strengthening from where it is right now before the end of this quarter. I don't know if any of you want to jump in and look at some of these other questions. I think there was one, for example, on productivity and innovation things. I think you addressed that in your slides, Peter, taking into account ESG related R&D.
Taking what into account?
There's one from Darren. Hi, any thoughts on entry into the technology sector? Also, does the productivity and innovation names take into account ESG related R&D?
Yeah, so no.
Your microphone's... Oh, yeah, sorry.
It's a good idea to have it in front of you, otherwise nobody can listen. No, the productivity and innovation list does not take ESG into account. My comment on technology, we get this from clients. So the biggest takeaway in equities right now is the discussion between nominal and real rate returns. It's not a discussion that has been relevant for 30 years because of low inflation numbers, but equities suddenly, if you look at equities priced in inflation terms, we're down over the past 12 months. If you price it in commodities, we're actually in a 15-month drawdown. So that this is really one of some of the things you need to think about. And lots of what we're talking about is getting the exposure to the commodity sector, inflation protected bonds, real estate. Those are probably the three things, and then make a caps with pricing power. Those are the four components that we expect to do well during inflation. So what about technology? And our general view on technology is that it's part of the economy that's still delivering a lot of growth, but there is an interest rate sensitivity, and it's very difficult to nail down exactly how big it is. So I would argue that you should still have technology in your portfolio. It's just a matter of getting a better balance in portfolios on equities. I think that's the main takeaway from what we're talking about on equity strategy these days. There was a question on. I think there was a question on. On aging population, the aging population theme. I think the best way to basically invest in the aging population theme is in what we have tried to come up with our own theme basket, which is called the Next Gen Medicine basket. I think everything that is related to medical technology or mRNA technology or other types of technologies that will propel these the life expectancy onwards from here is what you basically is betting on, or should be betting on. And the past century was called the computer age, and I think the next 80 years of the rest of this century is by MIT and others being called the century of biology. So I think biotechnology, next gen medicine, medical technology, I think should be a core part of the portfolio as well. And I think it really correlates well with aging populations, and then inside aging population you have a spin-off theme, which is called which is on demographics, right? So the dependency ratios are going up, and that naturally leads to us in the developed world that if the dependency ratio go up, so we have fewer hands to deliver the economic activity to support a lot of elderly people, the only solution is to become more productive, and you do that by automation and robotics. So that's a different way you can play the aging populations. And I think there's a question on POTAS maybe for you, Ole, if you can see the question.
Yeah, thank you for lobbing me that one.
Why not?
And that's not my. It's not one that I follow that much. Obviously, we know the link to gas and the end product, but I think there's one which is from a helicopter perspective slightly more interesting, and that was the question about the super cycle, or someone being surprised that we talk about a super cycle instead of just a cyclical phase in the market, and what really determined the length of such a cycle. And I think as I showed on one of my slides, the commodity markets have to balance. The difference to other markets, commodities it's a supply and demand market, and if we are in what we are seeing right now is increasingly it's finding it increasingly difficult to continue to find the supply that's required to keep to meet the demand. We've seen that for a number of years. ESG obviously turbocharged this phenomenon because investors would staying away from mining companies, from oil companies. And unless we see a change in the ESG regulations and make it more acceptable as investments, then I think that will continue to be a main driver. So the length of it really just all depends on the length time it takes before we get a balanced market again. And you can argue that we're most likely going to face an economic downturn in the US and perhaps also here in Europe. But at the same time, countries like China are likely to go in the opposite direction. So starting to applying additional stimulus to the economy, and we have to remember that 50% of global commodity demand comes from China, more or less. So that source of demand will not diminish once we get on the other side of these COVID-related lockdowns. At the same time, the green transformation will turbocharge demand in many regions, especially here in Europe, as I mentioned, and that basically requires metals of all colors. And it is with that in mind, and the lack of response from producers, because the old saying that the best cure for high price is a high price, because it incentivizes production and it curbs demand. The part of this incentivizing production part of that equation is struggling right now due to ESG regulations, and that's why we see that we could see a prolonged period of elevated commodity prices. But as I also mentioned, we just come out of a quarter where we jumped 24%, more than we jumped all of last year, which was the best year since 2020. So we are in a very potentially a little bit of a frothy market here, but it is a market that we think we want to be involved in from the inflation hedging perspective. Just before I pass it back, I'll just one question: when do you think gold will take off? Well, I hope it won't take off. I hope it will just quietly move higher, because when the market that takes off tends to come back equally fast. So I think it will just be the underlying continued strength of demand from longer term investors. adding support to the market. Indian buyers have been absent the past few months because what tends to happen when we see a new change in price, then it takes some time before they get used to these levels and they start to buy in again. But we believe there are already some pent up demand coming from China. Central banks will continue to buy as well. So I see this as a slow grind higher. And perhaps we will see obviously several. If we do take out some previous highs, we will see some additional momentum quickly clear some percentages. But generally, I would like to see it as a slow grind higher, because I don't like these sharp rapid moves, because they tend not to last.
Okay, we have a couple more time for a couple more questions. I think I'd like to just really briefly address the one on, do you think higher inflation will add the brakes to the bull run? And equities, I assume you mean. Of course, the blah, blah, blah. What could be the sector benefiting from high inflation? I think it's so important for folks not just think of inflation per se, but also real interest rates. So, it's one thing to have 7% inflation with 2.5% rates, for example, in the US, 2.5% being the 10-year rate, and the short rate being even lower, of course, if you look at the cash rate, and then having, let's call it, if we have the Fed succeeding in tamping down inflation, but it's still 3 and 4%, it's very elevated relative to the last few decades, but the policy rate, or the 10-year rate at least, is closer to 3%. In that case, in the latter case, you're talking about, Peter, and I'll get you in here on what does better. It will be those companies that are, have a high yield, high earnings yield, I would presume, and growth is less of a premium in that type of environment. Whereas if negative rates stay highly punitive, it's a bit of a different ball game.
There are many flavors and many answers to that question. So in the current environment we're in, the commodity sector will do well. It's really, and I mentioned inflation protected bonds, real estate, but also, I mean, rising nominal interest rates will increase the financing costs. So companies that apply a lot of debt on their balance sheets to leverage their operations obviously are companies that are vulnerable. Small caps in a rising interest rate environment also have difficulties, at least the small caps that can't grow fast enough, because they lose access under these rising financial conditions. John is right about the real rates versus nominal rates as well. I mean, banks are a part of the market that in theory should do well, but I don't think they will do too well if the interest rates are too the real interest rates are too negative. So right now the yield curve is flattening in the US. That's holding US banks back a little bit, but the higher interest rate level in general will begin to accelerate their interest income. But that's not. I mean, but if the real interest rate is -4%, so let's say if wages go up by 5 or 6% for banking employees, and interest rates only sit at 3%, then it's not a good thing. So so that's something to consider as well during this inflation. And then there's the whole discussion about to what extent it impacts valuations. It's important to keep in mind that equities is probably the most difficult asset class, in the sense that one, it prices the future and future cash flows, so it makes it a very volatile asset class. It's a nominal asset class. That's why it's so difficult to short, because the nominal economy tends to go up all the time. That's why we have this discussion between nominal and real rates effects. In the 70s, the earnings growth rate in the S&P 500 was actually much higher than trend growth, the historical trend growth, and for obvious reasons, inflation actually lifts all boats. So it's about, that's why we constantly say it's a relative game you need to think about. And I actually want to jump into the question on cybersecurity, because it's a question where why do we like cybersecurity, and how does it fit into a rising interest rate environment? So if we look at the US 10-year yield, it's up 200 basis points since the late July 2020. In the same period, the cybersecurity industry has delivered around 11% return annualized over that period. So you have to realize that the cybersecurity industry is an industry that is growing around 20% per year. So it's one of those industries that actually can grow itself faster than the headwinds from higher interest rates. So the higher the discount rate on those cash flows, it's very important to have that in mind. And And then the thing is that the cybersecurity has turned out to become a necessity. So it's not an industry that is cyclical at all. It will see high demand whether the economy is weak or strong, because just like you need an operating system for Microsoft to run a business today, and you need auditing, so auditing firms are always doing well. The same with law firms, right? It's the same with cybersecurity. It's a necessity to run a business, and that's why it will have a very low correlation to the business cycle, and those type of industries will always have a high multiple when you at the same time has a high return on invested capital. So I think if you have a tendency to be a little bit of a value investor, then it can be difficult to invest in cybersecurity, but it's one of those long-term themes where you probably have to, reduce your bias on buying cheap stocks and just, think about the long term for this industry. That's it.
Yeah, and maybe I can add John, maybe I can just add that there are some questions also on the profitability and also for the cybersecurity companies, and also questions on which of them are doing best. I guess doing best is sort of seen in their revenue growth, but there's a table in the PDF of the quarterly outlook, which you can see. You can see the PDF either in Saxo's trading platform under hot topics or on our homepage, where we do have individual articles for all our contributions to the quarterly outlook, and also this specific table on cybersecurity, which you can take a look at. Thank you.
Yeah, that'll wrap it up. Yeah, analysis.saxo. If you just pop that in your browser, if you're browser based for the Outlook, it's a top little special link at the top of that page there. Or as Anas mentioned, the hot topics if you're in the platform itself, because I think there's only a link to the actual slides PDF for this webinar specifically. All right, we're running over an hour now. We thank you very much for your attention. Hopefully you found this session useful. And of course, we host one of these with every quarterly Outlook. So stay tuned in the future for the next Outlook, and we'll see where things are going. I think it's a time of plenty of uncertainty, given all the moving parts we have here in geopolitics, big policy impulses coming, and everything else under the sun that's happened over the last quarter of this year. Take care out there. Be careful, and until next time. See you then.